Good evening, ladies and gentlemen. Welcome to ET Interact. Today we have with us Mr. Sahil Kapoor, Chief Market Strategist at Edelweiss Financial Services. Market in the last few years has left investors in a state of confusion at a time when gold has lost its haven appeal and equities are marked by unprecedented volatility. In today's webinar, Mr. Sahil Kapoor will help us pick up sectors that are likely to outperform in the current scenario. As the chief strategist for the research desk, he is responsible for driving trading ideas and strategies in equities, derivatives, commodities, and currency segment. He has been instrumental in driving the market strategy for the research desk, which provides views on the overall direction of the stock indices and broader markets. He will start his presentation shortly, after which we will take questions from the audience. Over to you, Mr. Kapoor, to take us through the topic. Is India still in sweet spot amid worries over US Fed hike and China market crash?
Okay, we'll talk about a few things today. So as I mentioned, we'll talk about why India is in a sweet spot, what are the key factors which make India enter such a state. Then we'll talk about what are the current scenario, what are the current macroeconomic factors which are helping India in terms of having lesser volatility compared to the world equities, specifically the emerging markets. Then we'll touch two very important points. Lately China has been in a lot of news headlines. You've seen China intervene in the forex market. They have cut interest rates. The devaluation of Yuan that we saw last week. They have also come and supported their equity markets. So we will try and make sense of all this. What does this mean? We'll try and make sense of how does it impact the Indian market and what you should make out of it. And thirdly, Federal Reserve has been in news lately for an expected interest rate hike. So we'll come and make sense of why and when Fed can raise interest rates. What are the important parameters that the Fed watches when they try to ascertain whether to raise rates or not. And thirdly, in conclusion, we'll talk about what all this happens whenever this rate hike happens, whenever the Chinese react to markets. What does the Indian market do? What will be the impact on the Indian market? So we'll talk about all this in conclusion, and we'll also talk about what is our view on Nifty and a few sectors. So I'll begin with my presentation, and we'll look at various factors that we just talked about. So we'll start off with the structure that we talked about the Indian GDP. So if you look at the history of world GDP, the most important parameter to watch out is that for the last about 2000 years, India and China has been the biggest economies in the world. So they have contributed significantly to world GDP. And you see these two countries were the biggest economies, and the precise reason was their very large population. So but in the last 200 years, this large population has not contributed to a very large GDP in the world share. So the graph that you see here, so if you look at the overall share of Indian GDP and Chinese GDP, so earlier this share was very high, and lately in the last 200 years it has fell down significantly. And the countries like Germany, US, France, Italy, Great Britain, they have taken over and become one of the largest. And there are a few factors which have helped them to become very large. First is that they have leveraged technology. So in the last 200 years, population did not matter, technology mattered a lot. Second is the invention of two very important things. First was the steam engine, and then the internal combustion engine, which used diesel and other fuels, and which in turn created railroads and automobiles. So these 3-4 inventions have taken away the lion's share of GDP from China and India towards West. And now if you look at last 20 to 30 years, India and China has started using this industrial leverage and they have started moving up in the world, as on account of per capita GDP. So, just to summarize this slide, it talks about why certain countries have high GDP and why India and China lagged behind in the last 200 years. And the reason for that was industrial revolution in the West, which did not happen in India and China. But in the last 2 decades, we are seeing that India and China are now leveraging this technology and going ahead. So if you look at India specifically, so Indian states, if you look at each state in India, so economically Indian states are as big as countries. So if you look at this slide, you will see that the whole host of states that we have, you can compare them in terms of their GDP to different countries. So for example, Maharashtra is comparable to Finland, UP is comparable to Vietnam. So in terms of GDP, we are very, very big. Right now, the Indian economy is about 2 trillion in size on the GDP. So it's a very large country, but in comparison to other big, Western countries and China, we are still small. Like US is closer to 17 trillion, GDP. Eurozone put together is about 14. China is closer to 10. So we are still small in comparison to these big economies. But per se, if you look at India, we are combination of a lot of small countries. So our GDP per se is very, very large. Even a single state can compete with a country per se. So for example, if you look at the next slide, just to give you an example how large we are. So in terms of population, Indian population is close to 1.25 billion people right now, 125 crores. So this amount of, this number of people, this large mass of people, if you look at globally, there are countries which can, get into a single state. So just to give you an example, Uttar Pradesh, if you were to think it as a different country altogether from India, it would be the world's 5th most populous country, only Uttar Pradesh. And it will be in size comparable to Brazil. The whole population of Brazil is in Uttar Pradesh, that is UP. And but its economy is only the size of a Qatar, which is a very small oil-rich state, which has only 2 million people. So per capita GDP is very, very small. So despite our 2 decades of growth, UP's GDP per head is close to that of Kenya. So in comparison to the number of people we have, our GDP is very small. That means our productivity is very, very low. So these 2 slides clearly show you 2 things. First is that in terms of size and scale, India is very big. And secondly, there is a lot of room to grow. So in terms of number of people, we have a huge population. But up until now, that population has remained, a challenge rather than an opportunity. But going forward, it can become a very large opportunity. And to understand why population can become a very large opportunity, we move to the next slide. So we have a big, demographic dividend. Now, what is demographic dividend? So the acceleration of economic growth resulting from a change in age structure of a population. So, once your population crosses a certain threshold, generally the economic growth can slow a period of time. So just to give you a few statistics, by 2030, India is expected to have about 28% of world's workforce. So all the people in the world, at least 1/4 of all working people in the world will be in India. And our total population will be close to 1.4 billion people at that time by 2030. So 2/3 of India's population is under national average of 26. So India is in midst of a structural reform. Our overall size and population is very, very large. Plus we have a great opportunity in terms of large number of people who are in the working class. So if you look at this slide, the number of people who are going to work in China has gone down. In US they are very small. The population size is small. Plus the proportion is also very less. Europe is also going down. Africa is going up. But the whole point is that if the number of people who are able to work, that is the working population, goes down, that means people who are going to feed off from those people are going to go up. So in terms of your spending in terms of pension and healthcare will be a drag. So India will not be in that bracket. So we have this unique demographic dividend that India can earn. So now what is the most important thing in having this demographic dividend? First is that we most important thing is that we need to have a skilled workforce. So right now that is a very big challenge. So only about 2% of our existing workforce has undergone any formal skill training. So which is a very, very small number, and that means 98% of people who are working in India has no skill training ever. And only 15% of them has marketable skills. That means if they want to get employment, only 15% of them have skills which can be marketed as an employee. And it is estimated that 90% of jobs in India are skill based and they require vocational training. So out of 100 jobs, 90 require skill and only 2% people have skill. So there is a big gap in terms of skill that collectively as a country we lack. So in last 3-4 slides, it is very, very clear that what is required. So what is required is a skill program that the government has already introduced. So that is a amazingly important step which gels into the long-term demographic dividend that India can earn. Second is that you need to have jobs. If you skill people and they don't have jobs, then it will not be fruitful. So Make in India is another area where the government is focusing, and it can create a lot of jobs. So manufacturing sector generally leads to higher and wider employment plus higher and wider wages. So that can be a good opportunity for skilled people to get employment. And third point, which has come up in the last few days only, which is the Startup India. So there is a certain amount of focus that is being shifted towards more entrepreneurship, and to that this will drive a lot of private sector jobs. So the government is doing its part, but if you have a lot of startups, it will drive a lot of jobs in India. So if you can connect these dots, there is a huge potential, there is huge population, and if you are able to provide skill and provide job, it can create a huge large opportunity for India. So in terms of economy, so we are one of the highest growing economies for the last 15 years. So you can see China, India, Indonesia, these are the top growing economies of the world. So in most of these economies that we have mentioned, other economies, China is witnessing a slowdown right now. Indonesia again witnessing a slowdown. Russia is in a lot of problem with huge fall in commodities, specifically oil, which accounts for about 50% of its GDP. Turkey again is very unstable right now because of political reasons. So in totality, the top 5 countries, India is the highest growing for the last 15 years, and right now also it is the most stable among its peer set. So it's a good outperformance that India is showing in terms of the overall growth of the economy. And with a 1.4 billion population plus what we discussed on the last slide, if we have a large skilled workforce, that is a very important step that the government is taking. And if we have decent per capita income because of the job growth that we can see going forward, we'll have a disposable income which is sizable in nature. So overall, if you connect all this with what kind of economy India is, so India is largely a consumption-driven economy. That means a lot of people, consume a lot in India. So it's a comparison of how much consumption takes place in India. So the top countries are UK and US, where people consume about 80 to 85% of their income goes into consumption. So India is close to 70, and we are growing. So largely, if you connect all the points that I mentioned earlier, where people are employed with skill and there is a sizable disposable income. So if you have a consumption-based economy, that means it's a very explosive mix for the country to grow very, very strongly over a period of time. So largely, if you look at the points that we mentioned, uh, they clearly pinpoint that why India is in a sweet spot. So the if you were to sum up why India is in a sweet spot is that we have such a large population which is right now on the verge of getting large amount of employment options. Plus you have a program where you are going to get skilled. Plus you are in a spot where most of your peer set is undergoing a lot of problems. So in terms of all angles, India stands out, in terms of the overall economic growth that can happen. So now coming to what is the opportunity and how do we, ascertain that India can, do whatever we've talked about. They can get skill, get more jobs. The economic growth can be very, very high. So the important point is that we have to create a new India. The existing structures that we had, till about 2000s or even 2007, most of those structures have not helped the growth in a significant manner, although it has created a new platform for India to grow. But what new needs to be done? So right now, if you look at, there are a few levers that is working for India. First is that the inflation is falling. Okay, that is largely because of commodity price fall. Secondly, we had a huge fiscal problem where our the country's balance sheet, had a lot of problem. Overall, our imports were very, very high with very low exports. So that impacted the currency in a significant manner. If you remember, in 2013, rupee moved from about 53, 54 levels to 67, 68 levels in a span of about 3 to 4 months. So that is where India had huge amount of problems. But in the last 2 years, you see inflation has corrected significantly. CPI has fallen from about 14, 15 levels to 3.8, which was the last reading. And plus we have some revival in growth, although that revival is not very strong right now, but we are beginning to see, things getting back in place, a lot of investments being done. So specifically, there is a large focus on infrastructure by the government. So they are spending about 2.46 lakh crore in the current fiscal on infrastructure. They have a target of about 30 kilometers of road per day, which is a very, very strong number. Before this government started working, the number was close to 7 kilometers a day, which was very small, and we are already approaching about 12. So we are progressing significantly towards that. There is a huge investment in railways that is going on and in ports. So all these put together are expected to give a strong, growth revival. So this is leading us to, a period which, you can mark as Goldilocks, where all the important levers, which can go right are going right for India. So earlier in about 2013, we had a period where everything which could go wrong for India was going wrong. Oil prices were rising, inflation was rising, there was significant unemployment, interest rates were high, international markets were undergoing a lot of pain. So, but right now we are seeing there are, important changes that have happened, which has put us into a, great shape. See, firstly is that our inflation has come down significantly, and that has, happened because of two reasons. First is that we had a huge slide in commodity prices internationally. So international commodity prices have been a key driver of inflation in India for a very long period of time. Second big driver is the structural bottlenecks on the supply side in India. So in the last 6 months, the government has tried to, uncoil those bottlenecks, and they have tried to, widen the supply net. And largely, we are seeing that that is, helping out the country to a very large extent. Our CPI has fallen, as already mentioned, 14 to 3.8, and just to mention here, 4 to 6% is the RBI's target range for inflation, and last reading was below RBI's target range. And it's RBI's mandate to keep inflation in that range. If it falls below its target range, then it has to report to the government why it has happened and what are the steps RBI is going to take. So secondly, with the fall in inflation, you are seeing our fiscal situation has improved a lot. So fiscal deficit as a percentage of GDP, it has gone down significantly. We had reached about 7%, which was an unsustainable number in 2010. Largely that was on back of the fiscal stimulus that we gave. So right now it has come to 3.9. The government has estimated to maintain it at 3.9% to do a lot of spending also. So this is a comfortable number. Secondly, our current account deficit, that means import minus export, that has come down significantly. We are at about 0.2% now in the most current reading. So mostly the CAD is wiped out. So that is a important indicator that is helping out India. The second big factor that I talked about, or rather the first, is the commodity crash. So let me give you the important pointers of how it has helped, India. So if you look at crude prices individually, they have fallen from about 120 barrels for the Brent crude to about 47 right now where they are trading, which is about a 60+% fall. So what this does is that if oil prices fall by $1, they help save about 7,000 crores for India. So this kind of saving is huge, and the government has clearly, raised duty on oil and tried to collect more revenue, and they have come and said that they will spend this revenue on infrastructure. So that is again a welcome step for the long-term growth story that India is representing. Secondly, a lot of emerging market currencies you can see has gone down significantly. So today also you see rupee making a 2-year low, but if you compare this to other currencies like the Russian ruble and Brazilian real, they have fallen in excess of 30-35% in the last 6 months only. And Indian rupee is down about 7% this year. So Russian ruble, for example, in the last 12 months, it's fallen about 80%. So India is in a much better shape compared to all of the emerging markets. So that has also helped keep inflation in check. So because inflation causing commodities like oil and other agri commodities, they have fallen significantly. Plus our central bank has maintained a lot of positivity in the international market by collecting a lot of forex reserve. That has helped the rupee to remain stable, and we expect rupee to continue to remain stable. In the short term, there is a pressure on all emerging market currencies, but we feel that rupee will outperform that period of short-term depreciation. So overall, if you see what this has done is it has increased a lot of confidence in India. If you look at the FI flows, the FI flows in India has gone up significantly. They have invested about 23,000 crores in India in YTD this year from January onwards. And the most important change that has happened is the huge investment by DIs. So DIs were net sellers for the last 2 years. They have come back this year and they bought a large number of stocks, and largely this money is coming through mutual funds. So this year only they have invested about 27,000 crores. So we have a huge significant buyer who has come back to Indian markets. Plus you have foreign money which is again flowing towards India because there are not a lot of choices that are left globally. Because if you look at the peer set, Brazil is going through a lot of problems. Russia is going through a lot of problems in terms of commodity prices. China is seeing slowdown. So out of BRICS, only India is the country which is witnessing a lot of stability. So a lot of money is chasing Indian bonds and equities, and in terms of FDI, we are also clocking very strong numbers. So overall, we feel that this confidence will continue and India will continue to attract capital. Plus, as I already mentioned, central bank has, they have been buying dollar and they have supported the increase in forex reserve. Forex reserves have gone up to about 353 billion as per the last reading. So, so you can compare this to any number like months of imports cover. So we are at a very comfortable level. Most emerging markets are witnessing, strong drawdown in their forex reserves, largely because they are trying to, support their currencies. Like in the last 10 days, Malaysia has seen their forex reserve dip below 100 billion, which is a significantly low number. The same is the case with Brazil. So most of these countries are trying to defend their currencies, but India is not doing so, and we have built a strong 350, $360 billion forex reserve, which is supportive, and it can help the central bank to a very large extent. So as I already mentioned, Make in India is a very, very important step, and we feel that it is one of the important components of the Goldilocks scenario that we are talking about. Uh, so the government is targeting about 25% contribution to GDP in the next 10 years. It's expected to make about 17 million direct jobs and about 85 million indirect jobs. So in totality, about 100 million new jobs, which is a very, very big number. We are also targeting about zero imports by 2020 for electronics. So just to give you a number, India imported about $37 billion of electronics, this year, in the year 2014-15. And if you compare this number, it is almost 60% of our oil bill. So it's a very, very large number. If you are able to cut this down in half also in the next 5 years, it will be a huge positive for the Indian economy, because it will create jobs, it will improve the fiscal situation, it will help the currency, and it will also attract a lot of capital. And the government is also focused on defense as a sector, and they want to create defense exports. So that will be a very, very important area, but that is a long-term goal. According to our analysis, it will not be met in the next 3 to 5 years. It will take a longer period of time, but it's nonetheless a step in the right direction. And another important point is the DBT, which is your direct benefit transfer. So if you look at the numbers, the government has, created this scheme where the subsidy for LPG is directly given to the beneficiary. So, good thing has happened that India has been recognized by the Guinness Book of World Records as the largest cash transfer program in the world. So, in just a span of about a year, we have done this, achieved this remarkable feat, which is very, very important for the economy as well. So it is now helping us save about 15,000 crores, by stopping black marketing and diversion. So it's a very, very important number, and because each individual uses LPG, and it's causing a real, on ground change for the government. So the overall payout for the government in 2014-15 for LPG was about 41,000 crores, and previous to that it was 52,000 crores. So this year it will be even lower. So overall we are seeing this is rubbing off positively, and there is also this important point where 20 lakh people has given up their LPG subsidy. That is also government's initiative of driving that positivity. So that is also helping government bring down its subsidy burden. So in totality, we feel these are the important points which is making India, a country which is into Goldilocks period, that is low inflation, possibility of very high growth, great contribution from the government in terms of expenditure on infrastructure, and which will continue going forward. Also, we are witnessing that globally there are not many options to invest apart from India, so that is attracting a lot of confidence in the domestic market. Plus, we have a very strong, credible central bank which is supporting the currency to a very large extent. There are 2-3 important factors which are not working in our favor, which needs mention here. First is that we have seen some delay in reforms which are expected to happen earlier. We have seen GST and land bill getting delayed. But we feel that these are short-term delays, although they matter a lot. They act as negatives in the short term. But right now the government is talking about a special session which they can convene to pass the GST bill. So that can be a very good positive for the short term and medium term as well. But it's a long-term effort. The fruits of GST will come in maybe 5 years or so. So, but as a sentimental booster, it's a positive. But we feel once it happens, then only you can take a time window of when it will be implemented. So overall, GST and land bill getting deferred will be a short-term negative. Secondly, we are seeing that central bank has been waiting for a while for the interest rates to go down. So we feel that that delay is causing some amount of a delay in terms of investments getting routed through equity markets. So that is a short-term phenomena where we feel RBI will wait for Federal Reserve meeting that we'll talk in detail later on to give a rate cut. So we feel September is a very, very important month both for Fed and for RBI, where some intentions will become clear. So now getting down to the next topic, which is China. We'll talk about China, why it is most important and how it can play a very, very important role in terms of the world market. So if you look at last few years, Chinese markets have outperformed a lot of global markets. Chinese market is outperforming mostly every other equity market, and we are seeing a big rise in China, which topped out in close to June, July. So since June, you are seeing Shanghai Composite has fallen significantly, and you have seen a big correction in China, which has shaken a lot of market. So two important things to mention here. See, the total market cap of Chinese equities is about 6.5 trillion, which is 10% of the world market cap. So Chinese market are very, very big. And they have lost about 3.2 trillion in market cap by this correction. So that also becomes a very, very important number. But the important point to note is that this Chinese rally was based on margin debt. So a lot of people borrowed money and they invested in Chinese stocks. And who are those people? Those are local Chinese people. So overall, if you look at the local speculation has increased multifold. So this blue line tells you the stocks which are bought with borrowed money, that means on margin debt, and orange tells you, the orange bar tells you which was bought on cash. So a lot of people bought stocks on margin money, so which is a huge speculative element. So you can see the total market cap as margin debt as a percentage of market cap, it had gone to about 4.5%, which is a huge number. So largely the margin book in China was closer to 400 billion, which Indian book is not even 1% of that. So you can imagine the amount of money that was flowing into Chinese stocks. And the most important point is that Chinese market has only 2% of foreign participation. So there are, out of all 100 traders or investors, only 2 are foreigners. So there is not a lot of people who hold Chinese stocks globally. So China making a difference to the world market through equity market fall is very, very difficult. So all the talks and news headlines and articles that you read about how China's Shanghai Composite can crash other markets, they are little out of place because there are a lot of investors who are invested in those stocks. The reason being they are not allowed to. So they are only allowed through a qualified foreign institution investor mechanism which China decides. They have a quota system. So that creates a lot of entry barrier for a lot of people. So overall, you see Chinese equity rally, it was largely based on the government's own intention to create such a rally. They had clearly gone out and mentioned to a lot of investors to invest in equities. So this was because they wanted to replace their housing real estate market with a strong equity market. So you can see the chart on the right, it clearly shows in the last 2 years, 3 years, Chinese housing prices have fallen significantly. So that has impacted a lot of savers in China. So the government wanted to create a parallel market, a more liquid, vibrant equity market. So they have been cheerleading people into equity markets. So which has clearly not helped over a period of time. It has created a lot of bubble. Second thing is, so what this whole China equity crash do? It has shaken confidence in a lot of people in terms of market participants, becoming risk averse. And the second most important event that happened was the devaluation of Yuan. So about a week ago, China announced that they are going to devalue Yuan, and they did so. And overall, there was a 3.5% devaluation that happened. So you can see they have intervened in all markets. So largely, this is happening because they want to achieve two things. First, they want to prop up their economy, improve their economy, and second is they want to support their equity market. So they have devalued Yuan. They have stopped accumulating forex reserve. This is, helping depreciate Yuan, and they have cut their interest rate significantly, about 4 times in last 9 months. So this chart shows you how many times China has intervened in different markets. So they have cut interest rates. They have asked their local firms to buy stocks, which is the Chinese, one of the Chinese company, um, which is controlled by the government. They have lifted cap on insurance company pension funds to invest in equities. They have suspended IPOs. Now they have reduced margin requirements also. So all these steps are being taken to do two things. First is prop up equity markets and the economy, and second, is to support a more stabler environment in China. But we feel that all these steps have not helped to a very large extent, although they have tried to intervene in all possible markets. But this is the most important slide that we are on right now. If you see, China does not have a big correlation with any of the markets. And the reason I already mentioned, the Chinese market does not have does not have participation from international investors. So that participation is only in Hong Kong, not in China. So overall, you see the Shanghai Composite, China does not have very strong correlation with either US, Brazil, or for that matter India. With India, its correlation is rather negative, so which is a surprise. But overall, we still see that there is no significant correlation between Chinese equity and other markets. So what effect can China have on India? So as I mentioned, there is no visible correlation. So we don't feel that Chinese market fall or rise is a great indication of anything that will happen in India. Secondly, China's banking system is very, very big, and that may come under a lot of stress if any bank were to come under pressure. So that is the most important thing to watch out for. If you hear news or see events happening where Chinese banks are getting into trouble, that is a place that you should put your panic hat on, because that will be the most important event. Right now, there is no event that has happened to that extent or any bank getting into trouble. So we feel that all the noise that we have seen is still a noise. And if you look back in history, this movement in Shanghai Composite is not new. So if you go back in history in 91, Chinese market doubled in a matter of, went up 14 times. That means it went up from 100 to 1400 in 11 months. And same thing happened in about 2004 to 2006, where they multiplied 6 times. So overall, Chinese market has done this again and again. So we don't think it's a new feature. But right now, it's getting a lot of news headlines because a lot of other markets are in trouble. So we feel India would benefit from a slowdown in China to that extent that some sectors like textile, auto ancillary will see some value migration happening from China to India. But there are not many sectors in which we can compare India and China, because Chinese are very, very large in scale. So overall, we don't see there is a huge negative impact that will happen because of China in the short term. Yuan depreciation can have an effect, but that will be limited to what will be the extent of depreciation. So 3% depreciation is not a big number. Rupee has already depreciated to by the same number, so we don't feel that it is a big change. Now getting to the last topic of discussion, which is the US Fed rate hike. Again and again, we've seen and heard people talk about that US will hike rates and it can create a lot of problem. So just to tell you, this is a history of US interest rates hike. So if you look at from 83, 84, there was a hike of 3.25% by Fed. And so it did not impact a lot of countries. Historically, Federal Reserve has raised rates many, many times. And there is no clear correlation that we can pinpoint that if Fed raises rates, other markets suffer. So although there are examples of, say, a 94 rate hike, which ultimately was followed by Asian crisis in Mexico and Brazil, but we do not have a very strong correlation with negativity. For example, one of the biggest rate hikes that Fed did was in 2004 and 6 of about 4.25%. In the same period, our markets doubled. So there is no clear correlation that you can pinpoint. Overall, if you look at for the last 35 years, interest rates in US are going down. So earlier they raised rates in about 2004 to 6 and took interest rates to about 4.75%. But that was still lower than the earlier hikes of 6%. So overall interest rates in US are headed lower, and right now also the trend is still down. So if you look at the 10-year yield or a 30-year yield for US bonds, the interest rates are still going lower. So which does not give us any indication that even if Fed starts raising rate, they are going to raise it significantly. So we feel that any hike between 25 to 75 basis points may not have a huge impact globally, specifically for India. For other countries, of course, it can have an impact like Brazil, like Russia, which are already in a lot of trouble. But what are the markets saying? If you look at the Fed fund futures, so the Federal Reserve has a target rate called Fed funds rate. And for that rate, there is a futures market, like there is a futures market for Nifty. People trade on those futures. So that futures are clearly pointing out that there is only a 45% probability that Fed will hike in September. So they will increase rate in September. So that is a very, very low probability according to us. We feel that there is a clearer chance of a December hike than a September hike. But the important point to note is, and that is our view, that the timing of the rate hike may not matter a lot. What is given is right now that Fed may hike by 25 basis points in this year. What is more important is how much will they hike. So right now we feel that they don't have too much of a room. The CPI or inflation in US is only 0.1%. Like our inflation is 3.8%, which was 14% earlier. In US, the same number is 0.1%, which is a very, very low number. Their target inflation is 2%, so they are running well below that number. So if you look at the Federal Reserve in the last 7 years, they have done various programs. They did, TARP earlier, then they introduced quantitative easing called QE, then they did QE2, then they did Operation Twist, and then they did QE3. So in each of these instances, if you look at, whenever they did QE, if you look at this green line, which is US 10-year yield or bond yield, or the interest rate on US 10-year paper, only in that period the yields were going up. That means markets were expecting a strong economic recovery whenever US was doing a quantitative easing. And as soon as the easing stopped, the interest rate started to fall. So although it is counterintuitive, but still that is what the market did. So if you look at the latest scenario, US ended quantitative easing in 2014, and since then yields are still down, they are not up. So saying that US is in a rising rate scenario, that does not seem so. The market is not showing that, the market is not doing that. So there is no indication to say that Fed will come and raise rates significantly. We've heard about lift off, raising of rates very strongly. The market is not showing that. So we feel that even 1 or 2 rate hikes, even if Fed does that to come out of this zero interest rate policy, it will be a token sign. It will not mean a big change in their policy. Their GDP growth is very, very slow. If you look at these numbers, unemployment has picked up, has fallen down significantly in US, but is still above the pre-recession levels. Inflation is a big trouble in US. It's still not picking up because growth is not very, very strong. So what the Fed is watching, they want their unemployment rate to fall further. They want inflation to pick up. That means they want growth to pick up. So we feel that the growth in US is still very, very sluggish, and that will not give Federal Reserve a lot of room to raise rates or significantly go higher. So I think this is what we wanted to discuss today overall. So I would just want to conclude with what we've discussed today. So there are 2-3 things. First is that we've talked about India being in a sweet spot. So India is in a sweet spot because of 2-3 reasons. First is that we have a very strong, sizable, economic, macroeconomic. The overall GDP that we have in each of our states is sizable, and the population set is very, very large. Secondly, we have a demographic dividend in terms of more people becoming, you know, getting into a age bracket which is of a workforce. So that will give us a lot of, people who are in that age bracket who can work. So that is a very, very positive step. Third is that we have introduced programs like Skill India. We have introduced programs like Make in India. And also we are focusing now on entrepreneurship through startups. So these three factors will help create jobs, help create more disposable income. Uh, and thirdly, we have a peer set globally, which is not seeing any growth revival. Most of the countries, specifically the commodity countries like Brazil and Russia, they are undergoing a lot of problems. So India is better off against all these countries. And plus, we are seeing lower inflation and higher growth period. So all these put together is giving India a good sweet spot to grow. Uh, so overall, what effect can put all these put together have? We have a very stable bond market. We have strong forex reserve. Our currency market is very resilient compared to other markets. So these are providing an edge to Indian markets over other markets. We have reduced rates by about 75 basis points, and they are expected to go down further, which is again a great lever for the economy to grow further. Uh, we've talked about yuan, so we feel a weaker yuan can impact nations which export, and India is not a great competitor for China in terms of exports. Although we can have some amount of problem with textile, steel, and auto components industry, but we feel overall it will not have a sizable impact because our market shares are not very, very strong in most of the sectors. Um, and also yuan, a weaker yuan can have trouble only if Indian rupee does not appreciate it. So we've already done so by the same amount. So we don't think it will be a very large negative for India. And overall, historically, as I talked about, there has been a huge number of countries which have undergone trouble because of Fed rate hike. But we feel that current macroeconomics does not show that India is one of them. India will probably sail through and it is in a better shape compared to all other countries. So we are not overly concerned with timing of Fed rate hike. We feel there will be a small hike which may have some short-term volatility, increase in volatility, but it will not be a big dampener for India. So overall, India has sufficient ammunition to stave off any volatile period and risk aversion. Although it will not be immune to everything, but we feel that it will do better off. If world markets fall by X percent, India will always fall X minus percent. So we'll have move in some same direction, but we'll have much lesser volatility compared to the other world markets. So we've also talked about the negatives, which is the delay in GST and the land bill, but we feel it's just a matter of time because government has shown great intention to pass these bills and eventually we'll see a passage. And overall, we feel Indian markets will do well. Our Nifty and Sensex targets are well defined. We feel that by the end of financial year, Nifty should head towards 9300 to 9500 bracket. That is by the end of March 2016, we should be closer to that level. So with this, I think I would want to conclude, and I would want people to ask questions. If you have any queries, you can go ahead and ask your questions. So we'll take a 2-minute break and we'll let the question queue assemble and then we can answer them. Thank you. So we'll take a few questions. There is a question from Mr. Ajit Kumar. So he asks that does falling inflation means the market will go up? And hasn't it been going up when inflation was going up also? And same is the case with interest rates. So the idea is that when inflation falls, it gives or it creates a scenario where long-term inflation expectations are anchored. That means people understand that if they put 100 rupees in the market, whether it is the debt market or the equity market, they are sure that how much value will get eroded from inflation. So when inflation is lower, there is a higher propensity to consume. That means people will go and consume a lot of financial products, invest in equities, invest in bonds. So that will give us a lot of investable surplus, and when a large amount of investments come in, so it creates an environment where people who need investment, they get that money. So it is beneficial for business owners, and at the same time it is also beneficial for people who want to invest. So lower inflation means lower rates, that means more demand for credit, plus there is a sizable opportunity when you have strong economic recovery. So there are times like in US, interest rates are zero, but for a very long period of time there was no investments coming in. So that was a period that you could say that even at lower rates, the economy was not doing a lot. So right now we feel that if inflation falls, it will give a sense of comfort to people who are bothered about currencies, and it will also be helpful in bringing interest rates down, and therefore it will help stock markets go up. So this may not happen always, but right now we feel that this combination will be helpful. Then there are questions. Mr. Adit Jain has asked who has invested significantly in India. So see, largely if you look at the overall composition of investments in India, there is about a 350 to 370 billion dollar investment that foreign money has done in Indian equity markets. That is only the FII part, and there is a very large chunk which comes from domestic investors. So in this current year, we are seeing a lot more local money getting into the market. A lot of mutual funds are seeing a lot of inflow, which is getting into the equity markets. And mutual fund, pension fund, these are the investors which are stable and long term. So when you have investments coming in only from FIs, it is generally more riskier in nature. So we have seen FI flows, but local flows have overshot them after about a period of 8 years, which is a positive. So we are seeing diverse set of individuals who are entering the markets. We are also seeing a lot of FDI happening. We have seen a lot of investments coming into new startups in India. Specifically the e-commerce players and the local taxi players. So that is again a very big positive. So these are all set of investors which are investing in India per se, and most of it appears to be sticky money, which will continue to be in the country, and it will support growth to a very large extent. And we have a question where Mr. Avichal Singh asks, despite global woes, why do you see Indian markets are stable? So as I mentioned, there are 3-4 points. Globally, markets are undergoing a lot of trouble because of commodity prices falling and commodity producers seeing that trouble. Secondly, we are seeing a lot of countries unable to grow because of high amount of unemployment. Like in Eurozone, you are seeing unemployment rates of 25%, 35%, as high as 50% for youth in Greece, 25% in Spain and Italy. So all these numbers are alarming. They are clearly indicating that these countries are unable to get out of a hole in their economy. So if you look at Indian economy, it has a few set of scenarios that I already mentioned: low inflation, stronger growth, a stabler government at the center, which was absent earlier, plus the reform agenda that we are already seeing, and also a very, very stable currency, courtesy the central bank, that is the Reserve Bank of India. So all these factors put together are helping out the country to be very, very stable. So we have a whole host of other questions, and so there is a question like what are the important factors which can, what are the most important indicators of a stock's health? So largely, let me answer that. The overall growth is one of the most important things, whether that is the sector growth or the stock growth that is happening. Secondly, whether the company in question which you are analyzing has any moat around its business, whether it is able to have a specific USP in comparison to all other stocks or companies that is there in the sector. Secondly, how much money does the company make on a cash flow basis, whether the money that is coming in is only an accounting entry or it is making real hard cash. And then the last factor would be the return on equity. What is the amount of money that it is making for its shareholders? So these are the few factors, apart from entry barriers, which are very, very important for any business. And availability of credit, So these are the few factors which are the most important, and you should watch them closely before deciding on any investment. So, I think there are a lot many other questions which possibly we can, you can email us or given a, chance that we can, answer this. So with this, I would want to thank everyone who's been on this webinar and who's interacted with us. And thanks for all the questions and thanks for joining. We would want to interact with you more, and we'll see you on more such sessions later. So with this, we'll end this webinar. Thank you very much.